Welcome to today's seminar, Tax Cuts and Jobs Act for Architect Business Owners, What You Need to Know for 2018 and Beyond. Attendees of the live presentation will receive one AIA Continuing Education Learning Unit. Please answer the polling questions throughout the session to receive your credit. If you have any questions during the seminar, please email them to chuck@rcthornton.com. Our sponsor for this webinar, AIA Phoenix Metro, is the active voice for the profession and the value of architecture through advocacy, communication, and education of its members. We have the chair of AIA Small Firm Exchange, Jack Leonard, the owner and principal at CREO Architects. Jack, will you please introduce our speaker today?
Sure. My name is Jack Leonard. Today's presenter is Chuck Thornton of RC Thornton and Associates. Chuck works extensively in the area of taxes. He's an author, lecturer, and a frequent webinar presenter. His firm's mission is to help clients achieve financial success through savings of taxes. Chuck is a CPA, personal financial specialist, a charter life underwriter, and a certified financial planner. He's also a graduate of New York University with a master's in taxation. And in the past, he's worked for the IRS. He is also the owner of RC Thornton Financial Solution, which is a personal investment planning firm. So hope you'll enjoy the webinar today.
Okay, I guess that's for me to get started. Thanks, Jack. I appreciate it. In fact, you know, you guys could probably see Jack's picture up there, and he said that this was the first time he's done this on the webcam, and I haven't done it, so he's a little braver than I am doing the webcam. By the way, just to let you know, we are RC Thornton Financial Solutions. Yes, that is an investment group, but we're also RC Thornton and Associates, which is a CPA firm, and that is the party that is presenting this to you today. By the way, we got to go through disclosures, so don't do anything wrong. That's what this one says. IRS Circular 230 basically says that you can't cite us as authority. You need to talk with your accountant to get whatever information you would need on these particular items. By the way, the materials are copyrighted. You certainly could send copies of these to your friends if you like to do so, but I guess we're not looking for this to show up in the New York Times or something like that. So if you have any questions, if you want, by the way, if you have questions during the presentation, email me at chuck@rcthornton.com, rcthornton.com, chuck@rcthornton.com. For two things. Number one, if you decide printing this handout was a little bit too complicated for you, you're welcome to send me an email and we'll send you a complete copy of this handout. And number two, although we may or may not be able to get all the questions, I will make the commitment to you that if I'm not able to get to the questions and answer them on this particular phone call, I'll certainly email you back with the response that I think would be appropriate for that. So now we talked about how you can get questions to us. Here's the three major areas that I'm going to talk about today. Number one, I'm going to talk about C corporate tax rates. I'm going to tell you right now, I don't think this is for you, but when this law first came out, everyone was saying, should I go back to the C corporation? So I'm going to nail that down for you because I know you will eventually be thinking about it when I show you basically the next slide that's going to be coming up on this. Well, talking about the 20% pass-through deduction. Now, there's other aspects here in this tax law, but this one here, we can take up almost all the time that we have for the presentation, and this is the big diamond that's in the rough that you will be interested in, and there's a lot of things you can be doing right now to plan for 2018. You don't want to wait until July, August, September and say, hey, I heard about this 20% pass-through deduction, because there's things you can be doing right now to be planning for it. So That's the real diamond in the rough here. And we'll have some other ideas. I'll wrap up, but we'll be running short on time in each of these ideas. Actually, I'll be talking about is a webinar in itself. And by the way, you'll see me sending you to webinars that we have on our site on those particular topics. So let's go ahead and get started here. Let's look at that C corporation. First of all, what entities could you be? I jumped ahead of myself.
If we have a moment, Chuck, can I interrupt you real quick for one of our poll questions before we get started?
Okay, I was getting so excited, I was just going to keep on going. By the way, these polling questions are the way to prove that you're here so you can get your CPE credit. That's why these little poll questions are here. Kit, did you want me to read these off? Is that how we want to do that?
Oh, yeah, sure. If you could do that, that'd be great.
Are you an architect who owns their business, or are you a part owner? Yes or no? See, these are not tough questions. They're just making sure that you're sitting in front of your computer so that you can get your continuing education.
Yeah, we're just going to give a few more moments for everyone to put in their answer, and then we'll get continued with the presentation. Thank you, everyone, for sending us your responses.
Okay.
I'll go ahead and close it.
Okay, so where I was going was you can have a corporation, and you can have a corporation that could be an S or a C corporation. Your configurations are you can actually form a legal corporation. A lot of people don't do that nowadays, but you could. You could be an S election or a C corporation, or you could be an LLC, which I personally favor LLCs, and it could be either an S or a C corporation. It turns out that quite some time ago, you can make an election for tax purposes to treat your entity as an S or a C corporation, but still be a limited liability company for Arizona purposes. And by the way, that becomes important due to state asset protection rules, which is another presentation in itself, but it's why I favor that. So now that we've established you can be a C or an S, even if you make an election to be treated like one, here is some differences that you'll see. You see a C corporation, income could be taxed at lower levels than individual rates in the past, okay, at 15%. Wow. That's pretty interesting. Maybe I am wrong about this. Maybe you should be a C corporation, but then you have to have the rest of the story. There's a double tax. Most people are not satisfied to let cash build up in their company and just leave it there because it's a 15% tax bracket. They want to take it out. So when you take it out, you pay taxes again on it. Now you're way above this 15%. On your S corporation, the income passes through. Sometimes it may be at a higher bracket than the 15%. By the way, this was a 2017 rule, and back it's changed. There's no double tax, and you might save some Social Security taxes because you pay a reasonable salary. Your salary does not have to be driven by the profit you make. It needs to be reasonable, but in a C corporation, you're driven by taking it all out. So you're subjecting it all to Social Security taxes, Medicare taxes, Medicare wage supplement. And so if you're over the Social Security wage limit, you might be paying another 5% just to get your money out of the C corporation. And also, too, there's no built-in gains tax, which is something that can happen with a C corporation. Now, when I say that, it's a double tax that you run into when you convert from a C to an S and you sell your practice down the road. You might have a double tax if you don't plan this out accordingly. So I'm going to assume for anyone who understands what built-in gains tax, I'm going to assume that there is no built-in gains tax in my discussion. But if you're thinking of selling your practice in the next, say, 5 years, and you've recently gone from a C to an S, you might want to talk with your advisor on that particular topic. Okay, here's what the old rates were. 15% up to $50,000, 35% if you make $10 million. That's pretty hefty. But starting in 2018, it's simply 21% all across the board. Interestingly enough, that means for the first $50,000, it's actually higher than what it was before. And in most cases, anyone who's out of service business is not going to be retaining a lot of taxable income in their business because they're taking out the cash or they're buying equipment, things that they can depreciate. So you don't really want to make them all C corporations. But if I don't have you convinced yet, let's use an example. Married filing joint, that's what those initials mean. With a taxable income of $310,000, the corporate income is $1,000. I'm making up my number. The tax is 21%. That means your net after-tax cash is $790. You say, but I want that cash. You take it out. The tax rate in this particular example is 24%. By the time it's said and done, you net $600. Translation is that C corporation and double tax turned into a 40% tax rate. Had you been a sub S, the tax rate would have been 24%. That would have been the end of the story. So you can see this double tax is the thing that causes the C corporation tax rate to be elusive. It's fictional. It doesn't happen unless you're happy to leave your cash in there forever, which is nobody's going to do that. Okay, here's another reason not to be a C corporation, and I still run into this. That's why I'm bringing this up, because if you are a C corporation now, you might want to consider switching. However, talk with your advisor about built-in gains tax. That's a whole day seminar, which I've given to a lot of accountants, so we won't get into that. But here's an example. Let's say in order to avoid the double tax, let's say you need to take a higher salary than necessary. Assume the profit is $300,000. And you're going to see in these examples, I use numbers all across the board just to illustrate things. But that would mean in order to avoid the double tax, you'd have to pay out $300,000 worth of salary. So after your Social Security wage base, which I believe is about 127 this year, Medicare tax still continues on 3.8%. And after the $250,000 worth of wages, there's an additional Medicare high earner type tax of 0.9. You add those two together, let's round it, there's an extra 5% in this situation of tax just for the honor of taking out additional salary as wages so you don't have the double tax problem. So if I could reduce your wages by $50,000, then there would be a $2,500 savings just from going from a C to an S. Plus, you get all the other benefits that we're talking about. So please, if you're a C corporation, talk to your advisors. There may be a reason why you want to keep it, but I doubt it. Okay. Trying to go. Oh, we got another question here, don't we? All right, now that I'm getting you guys all psyched up about this tax law that's coming, that is out, this deduction, and now we talk about the wisdom of why you don't want to be a C corporation. Are you glad you're listening to all this good tax information? Wow, look at that. Kit, 100%. Everyone's happy right now, so that's good. And you're going to get happier and happier as we go through this law. This is a great law for people who are in business. It's not a bad law for people who are not in business also, by the way. Okay, so now converting from an S to an S can cause a built-in gain, and there are ways to avoid built-in gain. So I'm just again saying, if you're now thinking, if you're a C corporation and you want to make a switch, make sure you visit with your advisor. We have this situation. We've done it with architects, and we've also done it with doctors where we're making these switches, but there's some gyrations you have to do to avoid a building gains tax. So just don't unilaterally do it. Talk to your advisor. But now you set yourself up to save yourself some Social Security taxes and start getting the 20%. So now we're just leaving this whole C corporation discussion. I think I've convinced you that is not the way to go. And so now we're going to launch into this 20% deduction that you probably by now have read about, you've heard about somewhere, because everyone's talking about this. This is the big one. This is where we're going to spend a fair amount of our time. Here's how it basically works. I got to build up with basics here, but basically you get a deduction of 20% of your qualified business income. What's qualified business income? Well, it's basically a business net income with some modifications. Like for instance, if you had dividends, you have interest, it doesn't include that. So in general, if you're a partner or subchapter S owner, you're getting a K1, it's most likely 20% of your K1 income that you're getting. So just as a starter, just to build on this, if your qualified business income is $100,000, you get a deduction of 20%, and now you get a $20,000 deduction. Just because you're you as a business owner. Isn't this great? So if you have $100,000, if you're in a 33% tax bracket, you get a $20,000 deduction, and you save $6,600. This is cool. This is interesting stuff. By the way, if you're in this situation, you might want to consider how you're going to handle your estimates for 2018, because a lot of times people build their estimates based on 2017's taxes. But you know right off the bat, even if you make the same amount of money, most likely you're going to have a reduction in your tax liability. I say most likely because someone could always disprove me with a unique situation, but I would say 95% of the time, if you handle this right, you're going to have some good tax savings. Okay, so now that you're thinking about what you're going to do with all those savings, let's start with some definitions. I'm going to turn you a little bit into an accountant. The reason I'm going to do that is what I'm understanding and I see right now is most accountants seem to be saying, let's wait about this until July after tax season's over. I can certainly empathize with that. But there's moves that you need to make right now. And when I go through some of this logic, and feel free to print out the slides and show them to whoever your advisor is, there's a little bit of a sense of urgency here. And so understanding a little bit of the mathematics would not be bad. So qualified business income means income from any trade or business other than a specified service, trade, or business, except architects, engineers. Look at that. See, except you're going to find out you guys are special. I don't know what you guys did. You must have lobbied for this because CPAs didn't get this, attorneys didn't get this, doctors didn't get this exception, but you guys did. You'll see what I mean here when I get a little further, but this is great stuff for you guys. A trade or business is if it's, and does not include your W-2 income. So if you have a W-2 income, you don't get a 20% deduction against that. Even though technically a W-2 is a trade or business, technically it's not for purpose of the qualified business income, the 20% deduction. Now, it says what are the components, what's part of QBI? We've already discussed so far, it's kind of starting with your taxable income of the business is where we said. It must be associated with the conduct of a trade or business. Okay, so you can't be an investor with a portfolio. It doesn't work for that. You could apply this to real estate entities. Hey, if you are renting a building that you own to your own entity, and maybe you've had this building for quite some time. People are getting 50, 55, been in this business for a while, getting close to retirement. They've run through the depreciation, and they're now starting to build up equity in there. They might be starting to have taxable income. Guess what? This could apply for the 20%, and you might get 20% deduction in your practice, and at the same time with the real estate, get 20% for that too. Watch out though for this, triple net leases. The idea of a trade or business is it's something you're carrying on with regularity, clearly. Being in the architect business, being in the CPA business, you're carrying on with a regularity. However, in your rentals, if you're just renting them out to yourself, your practice is paying the property taxes, it's paying all the repairs and maintenance, it's paying all the insurance or pretty much all of it, and you really just do nothing but collect the check, deposit in your account, your rental account, and maybe you pay your mortgage. That's going to be a triple net lease. And the position that everyone believes will happen is that will now be treated like investments, just as though you'd had a portfolio of stocks and bonds and things like that. The moral of this is you want to unconvert, you want to convert away from triple net leases into more of an operating lease. If you or your partners own the same amount in the practice and you own the same amount in the building, the economics is the same. Whether you own the practice yourself and you own the building the same, you don't care whether you have more or less rental income. In fact, you might want to have less rental income because it's subject to another tax, but you can change. One option is to change your leases to maybe shift the burden of the repairs and maintenance over to your rental operation and just charge more rent is what you're going to do in a case like that. You can see why you can't wait until July or August to be thinking these things through. The sooner you make these changes in the leases, the better you're going to wind up being. It does not include investment income, which we mentioned, does not include reasonable compensation paid in a taxpayer year, meaning that, sad, you cannot include wages as a computation of qualified business income. Clearly, this is for business owners. And for you folks out there who are partners, and some of you probably have partnerships or you have multi-owner LLCs, you aren't technically supposed to be on the payroll. You take what could be guaranteed salary out, and some partners do go on payroll just for the simplicity of this, but the guaranteed payments are treated like W-2 income, and it's not eligible either. Hence, there's a big opportunity for partnerships, and that is you may not want to have guaranteed salaries, and you may not want to have W-2s coming out for partners. Big difference. We're already making changes with some of our clients, getting them off the payroll, getting them off the guaranteed payments, and coming up with different compensation plans. Hence, you can see why you can't wait until July or August to do this, because once you've run things through payroll, you've kind of cast the die for this year. Okay, so architects, you notice you're special on new law. I keep on telling you that, but you can see why later. I just want you guys to think that you're special, because you guys are. And so let's see what we have next here. So while you're thinking about what to do with the savings, continued, what is a specified trade or business? Now, the reason I'm sharing this with you is I've already had some architects and engineers say, oh, I heard this doesn't apply to us. And so I want to nail down, this is for you, but here's who gets nailed on this. Services specifically excludes engineers and architects. By the way, this came out midnight in the committee reports. No one had any idea this was going to come out until the law got passed. I certainly didn't. But it says performance of services in the field of health, law, accounting, actuarial, performing arts, consulting, athletics, financial service brokers, your financial advisors, or any trade or business where the reputation or skill of one or more employees. So when you have your neighbor over, if they're an accountant, they're a lawyer, whatever, if they're in a category, you can kind of say, hey, what do you think about the new law? And they probably won't realize that it specifically excludes you from the exclusion. It doesn't exclude you from the treatment. It excludes you from a phase out that exists for this group of people that I just talked about. So if I was giving this to a group of non-engineers and architects, I would launch into a bunch of phase out discussions, but that's not necessary. All right, let's kind of build on this a little bit. Certain principles apply. Qualified business income starts with your taxable income of the business. You're on the cash method, accrual method, minus your depreciation, minus, by the way, if you're a subchapter S, all of your W-2 wages, including your W-2 wages. Now think about that. W-2 wages on the income side is not eligible for this 20% deduction, but the W-2 wages that you pay yourself out of your S corporation reduces your taxable income, which is subject to 20%. Anybody seeing an idea here? Same thing with partners, guaranteed salaries reduce your taxable income, but the income is not subject to 20%. Any ideas that you may see here? Now, maybe if you're thinking about it, I'm going to pop the cork on this and share it with you in a few minutes, but I just want to keep on drawing out how you handle guaranteed payments, how you handle your salaries actually makes a big difference on this. Okay, now, once your taxable income exceeds $415,000, a new limitation kicks in. Now, for all the doctors, accountants, all that, what happens is that it's over for them. Once they hit 415, it's over. For you, what happens is it kicks in, and it's further limited by 50% of your W-2 wages. So for most architects with the staff, this is not a problem. Or 25% of the W-2 wages plus 2.5% of your unadjusted basis. That don't worry about the computations. If this was a group of CPAs, we'd really get excited about all these numbers. I just want you to walk away with this. It turns out, you're going to see shortly, if your tax, and you notice how these numbers are bouncing around. I started with qualified business income starts with the taxable income of the business, and then I slipped down at the bottom. I said, but as a final test, deductions cannot be more than 20% of your taxable income from all sources. And then I say, whoops, once you get over 415, there's a further limitation. So there's a bunch of pecking orders that you have to go through in here. But in most cases, architects will be able to survive and probably get their full deductions. Do we have
Hey
some
Chuck, do we have
survey?
we have time for a poll question real quick,
Yeah,
Chuck?
let's do it. Give me a break. I'll get a drink here while we're doing that.
All right. Sorry to interrupt you. Let's see here. I'll just get this up.
Okay, what type of architect entity do you have ownership in? C corporation, S corporation, LLC or partnership, or LLC or partnership where you made an entity election to be either a C or an S?
It looks like we got a few
Okay.
people sending in some votes. If everyone will put their vote in real quick, we can get back to the presentation.
Okay, let me tell you what I've got here. It's changing. People are still voting. That's an easy question. We're going to have to make them harder. Let's see. I have to do my math, but that adds up to that amount. I'll tell you what it is. A lot of you, 43% actually have S corporations, 43% have LLCs or partnerships, and 14% have LLCs where the partnerships have made an entity election. So for you, 43% who are treated like LLCs or partnerships, I've got a home run for you coming up. So make sure you listen when it comes. I have good information for all of you, but I got a home run one for you partnership people. I'm going to just keep on playing around with some of these numbers so we can drill it home. If your taxable income is over 415, that means you start with my taxable income individually is over 415. Then I go and I say, okay, now I look at my business income from my architect practice, and I'm limited to, well, the 20%. And it starts, and I do my calculation, and there's a phase out. You'll see in a moment. But there is a phase out, but I'm not showing you that yet. I'm saving that for later. You're over 415. There is no phase outs at this point. So I get a 20% deduction of $250,000 worth of income. That means you have taxable income from other sources too, gains and pension distributions or whatever. But your 20% deduction of your $250,000 of qualified business income is $50,000. And the wages included in your net income from that entity is $40,000. And your unadjusted basis in the property to be defined later on is $50,000. So I know that I can take 20% of $41,000. That's a limit. Another limit is 20% of my QBI, so therefore 20% taxable income just went out the window. I think I might get $50,000, but now that I'm over 415, I can take the greater of, the higher of, 50% of wages. That's $40,000 times 50% is 20, or 25% of wages plus 2.5% unadjusted basis of the property. And basically that becomes $11,250. As a practical matter for most architects, the wages is the one that's usually going to give you the better number. If you're capital intensive, medical, for instance, they have a lot of x-ray machines, but they would be over this number anyhow. If you don't have tons of equipment, you're probably going to do better with the wages. And indeed, that's what's happened. So the deduction's $20,000. So let's go through what just happened to me. My taxable income's over 415. Okay, I got a different set of rules to come in. I start with 20% of my qualified business income. That's $50,000. Well, okay, I'm feeling pretty good about that. And then it gets ratcheted down because my income is over 415 and I don't have enough wages, which you may. I deliberately made this example where you didn't, but you may have more wages also. And this can include wages to you too at the same time. So we might need to do some planning and do it pretty quick. Hence, another reason why you don't want to wait until July or August to be dealing with this. Okay, there's the phase out rules. This is the part that I'm going to jazz you up a little bit with it, and then I'm going to leave it because it's computational stuff. If your taxable income, so let's go back to your bottom taxable income number, exemptions, although exemptions are gone next year, standard deductions, itemized deductions. When you go through all that, basically, if your taxable income is under 315, all this other stuff about property, wages, forget it. It doesn't apply to you. And by the way, if there's 2 or 3 partners in a partnership, that taxable income is determined at each individual's level. So it's possible you may have 315 and Jack may have $150,000 from other sources and his income might be 465. This determination is made at each shareholders or partners level. Once you have taxable income that's greater than 315 but less than 415, that's your taxable income, not your business income. The deduction limitation can start to phase out unless you have enough wages and adjusted basis. Remember, 415, that 20% was limited by 50% of the wages, or 25% of the wages plus 25% of your unadjusted basis. That's only if you're over 415. Under 315, your home free is 20%. Then between, they say you need to phase out your 20% deduction. Okay, so little table here. Taxable income less than $315,000, home run, 20% deduction. Of course, you like to make more money. It just means it's going to get limited. Taxable income greater than $415,000. Look at those limits that we've been talking about. Taxable income greater than $315,000, less than $415,000, limitation starts getting phased out. Hence, if you're hovering between $315,000 and $415,000, you might want to start strategizing how to reduce your taxable income, which is what we're actively doing now. Another reason why you can't wait until July or August to be dealing with this. Okay. Okay, you asked for it. All you guys are saying, hey, show me how to do this computation. No, you're not really. But I just want to show you here that you start with your qualified trader businesses. You start with 20%, and you're going to do a computation of which I'm not even going to really go through it. If you want this, you can email me. I'll send you a copy of the slides, and you can see the computations. Okay, I go through a computation here. Not really getting into it, but the point I want to get to is this. Hans and Wendy, married. They have taxable income of $345,000. Wendy's business, $75,000 profit, 20% $15,000. But I think I'm going to have some phase out possibilities here. And when you go through the phase out possibilities, doesn't mean there is a phase out. It turns out this calculation reduced her from 15 to 1,500. I could certainly go through the calculations, and if you were a bunch of CPAs, you'd probably really get a kick out of this. Just realize 315 to 415 is the sweet spot in this law, and that's the area where you can actually do some serious planning by finding ways to legitimately reduce your taxable income. And I'm going to give you some ideas later on. I think we might have a polling question. Do you have ownership in a building rented to your practice? I'm going to talk about this a little later on, but this will help me decide how much discussion to put on there. Do you have ownership in a building rented to your practice? Okay, I think we're set there. Okay, principles you should know. I know I'm being redundant, but I'm building, guys. I'm building on this. If your taxable income is $315,000 or less, this is easy. You get 20% qualified business income. Don't worry about wages and property. $315,000 taxable income of each partner, each shareholder. This is not an aggregate computation. In fact, you can reduce your wages. Now, if I want to increase my net income without impacting my taxable income, excuse me, maybe I can reduce my salary to a reasonable amount. By doing that, what I've done is I've increased my taxable income of the business, the QBI, and I basically could get an additional 20% on that. Now, you might say, then why don't I just, Chuck, reduce my salary from my S corporation down to nothing? Distributions first have to be classified as reasonable salary. What's reasonable is something you need to affect circumstances. I would say that you just need to decide what would you pay someone to do what you're doing. Or a partnership, don't pay a salary or guaranteed payments. It could be all of your profit in the partnership before any distributions to the partners. Wow, this is an advantage of a partnership over a sub S, because a sub S distributions first have to go to reasonable salary. Reasonable salary reduces the income of your qualified business income. It reduces your 20% number, and you get no offset for the salaries that you picked up. In a partnership, the law basically says that is your partnership income. There is no such thing technically as salaries, although some people do that. It says or minus guaranteed payments. So we're going to talk a little later on about what guaranteed payments are. There's a way that you can maximize your 20% deduction. So for you guys who have some type of partnership agreement on how you're paying salaries, stay tuned. Hence, another reason why I can't wait until July. You need to start making changes in your partnership agreement right now. So here's an example. I got a partnership, I got an S corporation. The net income before any type of compensation at all is $350 on both of these guys. Compensation to the owners, either as salary or as guaranteed payments, is $250. I get net income of $100,000. I get 20% deduction. This is what happens on this. Let's play around with this a little bit. There's that net income before the partnership and the S corporation. But let's say the compensation owners are only $50,000, and the S corporation, let's say that however you justify it, you think that $150,000 of W-2 compensation for the owners would be sufficient. Here's my intended deduction. On the partnership, it is $60,000. On the S corporation, it is $40,000. In my prior slide, where all the compensation was equal, the difference is $40,000 for the partnership, and it is $20,000 for the S corporation. My tax savings just on this move alone in the partnership has saved me $12,000 after taxes. That's a lot of money. How much would you have to make to pay the taxes to get $12,000? And on the S corporation, it's $6,000. So how are we going to do this? Let me just take a peek at my next slide before I get back to the cool. I want to talk about how you handle the partnership issues. If you make payments to partners that are determined without reference to the profits of the business, which is what salary is in an S corporation, that is deductible against your net income of the partnership and is not includable for your qualified business income at the individual level. So you and I are partners. We don't know what our profits are going to be next year. I don't work as hard as you do. I don't maybe have the same skill set. So I have agreed that my compensation is $100, yours is $125,000, and that's regardless of what salary or what the income of the partnership is. That's guaranteed, just like the word suggests. It's guaranteed. However, I could change my partnership agreement to say this. We will pay each of us on tiered allocations of income. Chuck, the first $50,000 of income, you get $50,000. Bob, the next $50,000 of income, Bob, you get $50,000, and so on, until we get to the point where we've already now consumed those tiers that we've created, recognizing that if we did not consume those tiers, there would be a deficit and someone would not get paid. They would get shorted based on what they were expecting. You could always say, but in the event no less than a certain dollar amount, and the amount that you had to pay out of that tiered allocation approach to guarantee what the amount would be, only that portion would be a guaranteed salary. Hence, that's why I threw in $50,000 in that example. You can't do this in an S corporation, guys. Unfortunately, you're stuck with a reasonable salary. Your argument is what is a reasonable salary. In the partnerships, I would get cranking on those partnership agreements very quickly to start making this happen. You don't want to get a track record of paying too many guaranteed payments. And if you're like some architects that I know, you just put yourself on the payroll as a partner anyhow because you don't want to mess with W-2 estimates. You might want to go back and change it. Payroll reports for March haven't been filed yet. You have a chance to deal with that issue. Pretty cool, huh? What do you guys think? I mean, we're coming up with some great deductions here already, and there's a nice scenery for you. Some good architect probably designed that house there that overlooks that lake and that village.
That's a gorgeous building and view. Hey, don't you like thinking about backpacking out there?
Yes, I'm a backpacker, folks, and that's why Kid's bringing that up. She's taunting me because I want to get out there and start backpacking. So I think
want to launch one more poll if that's okay.
Sure, let's do that.
Well, let's get that out really quick.
If you have a building, have you done a cost segregation study to maximize depreciation? So if you, depreciation that gets billed right there. I just caught that. We're accountants, though. We're good with numbers, not necessarily with the letters. But anyway, if you don't have a building, obviously the answer is you don't own a building. If you do have a building and you say, I'm leasing it, but I have no idea what you just said with cost segregation, the answer is no. And if you said, yep, I've done cost segregation, the answer is yes. I'm going to explain what it is in a few moments, but I can see a few of you here do own a building, and the cost segregation is something new to you. So good news, if you haven't done this, and you have yet to file your tax return for 2017, there's even some more cool stuff coming out that you can still do, and it's not too late for. Okay, just to kind of drive it home, just a couple examples here. Example, make sure you understand it. Jack Kuska, Schedule C. Taxable income is $150,000 from the business. His other income is $50,000. His taxable income is $176,000. He takes 20% times QBI, $30,000. Limited to 20% taxable income, $176,000. So therefore, so far, $30,000 takes it. Results a $30,000 deduction. His taxable income was $125,000. His deduction would be limited to the 20% times 125. See how I slipped that in there on you? You all thought I was going to say 30,000, but remember the ultimate limitation is the taxable income aspect of it. Okay, I'm not going to go through that. I'm going to spare you that. When I put it together, I use all sorts of calculators. What happens if you're over 415? There's some other contortions you have to go through. Strategy is you probably want to see if you can bring it down. So strategies. Can I reduce my practice income to get taxable income below 315 to 415? It does not mean that you have to get your qualified business income down. It could be that. It means that your taxable income needs to be down. So maybe I might install a more hardy, beefier retirement plan if that works on the economics. Maybe I could increase my pension contribution. I'm doing this with a dentist right now. We're doing it with some doctors also, but you might be a candidate for that. You might start looking at some of your investment strategies. I did not mention, but it turns out REITs are qualified business income, so you get 20% deduction there. You might get oil and gas investments where it reduces your taxable income. That could be good. Bonus depreciation, section 179, which you could take on equipment, that could be good. You could even try to come up with ways to accelerate charitable contributions. It depends on your situation. Not all these solutions fit for everybody. Some other ideas that can make sense: tax-free bonds, shifting income into annuities so that you reduce your taxable income. REITs, as I mentioned, oil and gas. Charitable gifts, perhaps front-loading with a donor-advised fund. There's a webinar. You can go to our link there. Excuse me, but you could do that for purposes of saying, I want to maybe take a contributions for next year and this year and put them into what's called a donor-advised fund so I can get my deductions one year, reduce my taxable income. Maybe I don't get the same benefit next year, but it's another strategy that you can utilize on this. By the way, cost segregation, which I will mention here in a few minutes, since a few of you that applies to, could be an excellent way of doing that. Something tells me there's another polling question coming up. Is that correct, Kent? Yes. Are you aware of the Arizona tuition tax credit programs that gives you dollar for dollar credit on your Arizona taxes that is from a share that your S corporation contributes? Now, I want to make sure you're clear on this. I know that you can make a contribution individually for a couple $1,000s. They let you reduce your Arizona taxes dollar for dollar. You don't pay the state taxes, but you go ahead and get a charitable contribution. This is something different in case it causes you to change your answer. This is if you have an S corporation. So my partnership people out there, this isn't going to work for you. But for you guys that have basically S corporations, you could calculate your state taxes and you can say, I'm going to donate this to one of these qualified organizations, and I'll tell you in a moment what you could get. Okay, actually 80% of you, 83% are unaware of this. So let's see if I talk about that a little bit more. We will have a slide coming up on that one here in a moment. Let's see. Okay, I'm going to go back to that slide because I don't have much more information. On the Arizona kit, I guess I lost my spot. Can you help me go back to that Arizona tuition?
I think it's coming up just a little bit later. It might be a few
I
slides
got
down.
I get so excited. I see these polling questions. I say, I know what's coming up, but let's save that for a little bit later when it gets here. There's also in this law cost recovery bonus depreciation. And if you buy property before 9/27/2017, it was before that it was 50%. If you buy it after 9/27, all the way up to 2022, it's 100%. By the way, this is for new and used property. For folks that have a building that they're leasing to their entity as of 2017, you're going to love what we're going to talk about in a moment. If you bought that building after September 27th, it's still some good maneuvering you can do, but it's just fantastic if you bought it after September 27th. So here's a way that you can reduce your taxable income. It may reduce your qualified business income. You have to think about that also. Also, more depreciation on 179, new or used, and that increases your eligible property from $500 to $1 million. As a practical matter, I don't think anyone here buys that much. There's some examples of what 179 depreciation could be for. So the depreciation rules are more generous. Okay, what's cost segregation? For you folks that own a building, this might cause you to want to go out and buy one, but I won't do anything for you now. This has been around since 2000, but I'm amazed how many people do not know about this. We've been doing this ever since about 2000, to tell you the truth. The IRS basically says that if you have a building, they recognize that it really has different components. It's not all real estate. Some of it's tangible personal property. And they will allow you to get what's called a cost segregation study. And if it turns out typically 25 to 30% of your building could be reclassified for tax purposes as tangible personal property, they will let you now go back and redo your depreciation and let you catch it up in the current year. Hence, if you bought that building after September 27th, you can now go back and say, it was a used building, and now I'm going to take my 100% deduction on the tangible personal property. What a bonanza this is. And if you have not filed your return, and by the way, even if you had a building before September 27th of 2017, it's still good. It's still great. It's just not quite as cool as if you bought it after September 27th. If you have not filed your return yet, I hope you guys are going on extensions. You can still do this for 2017 as long as you do it and you have this report done. You have to get a report. It's done before you file the tax return, and there's paperwork and stuff like that you have to file. It's a 3115 and so on. The reason this is good is if I can take future deductions out of the years 18 and beyond, when my bracket's lower, and I can stuff it into 2017 when my bracket's higher, and I don't have to reduce my 20% deduction in 2018 and beyond. So for people who have not filed tax returns for 2017, I don't care when you bought the building, but if you bought after September 27th, it's even better. Basically, there's a pretty good thing here. We also have a seminar on this. It is at that link, and you can watch a webinar that we did on this particular topic. Another idea, here we go, kid, I found it. On the state tuition credits, how this works is it's for schools, that it's for public charities, where, not public, it's private charities actually, where low-income level people can go to a private school. My sons went to Brophy's, there's an example, but there's lots of them out there. They're listed on the website. And what they say is if you make a contribution to your sub-S, they'll give you a credit that passes through to your shareholders. I didn't really get into this, but in another webinar we have on our website, your state contribution limits are limited to $10,000 for everything. Your state property taxes, your state income taxes, any other state taxes are limited to $10,000. If you are over that limit, some of you are, and we're doing this already, you might consider approaching one of these things and say, I would like to make a contribution so I can reduce my state taxes. Why? Because you just converted that into a charitable contribution. There are no limits on the charitable contributions, so you can convert from something that might not be deductible to something that is deductible. By the way, the state has a budget on this. Last year it was $84 million. You have to get into the queue with these organizations. They then submit to the state for approval to do an allocation to you. You need to pay the money within 20 days. And so therefore you cannot wait until July for this. You got to start approaching these organizations, seeing which one you're interested in, come to some grips with what kind of contribution you might want to make. Your worst case scenario, this is you broke even. The way the law is right now, you get yourself a charitable contribution. Another couple great ideas here that you can use. We are getting close to our end, but let's see, is there another set of questions here, Kit, that we need to do? I think there's one more set. Do you have some takeaway strategies that you might consider for your 2018 tax year? Yes or no? I hope you guys are all going to say, oh, yes, yes, I've got to work that vote up there. You business owners, for sure, should be saying yes. There's a lot of good stuff here. I have not really talked about individuals only, other than that state credit that you can do individually could be beneficial for you. Okay, so quite a few people here. And more on the new law, do not wait until October to do planning. You should have your thinking process done later than May. You need to adjust salaries. You need to change partnership agreements. You need to consider triple net leases. You need to consider whether you want to make contributions to your STO. There's so many things to do. You just can't wait until the end of the year and say, what do we do? If you decide to shift times, this can take time to change agreements and things like that. But this could be definitely worth it. And also, too, any strategies, you got to sit down and say, does it make economic sense to be doing this? So if you have any questions, please go ahead and send me an email, chuck@rcthornton.com. I can see we are running out of time, but I promise you, if you send them even the next hour or so, I'll send you an email to share that with you. And again, we also have some webinars that are up on our website on some of the topics that we talked about. We do not have one yet on the state tuition organization, but that is one of our next ones that should be up there in 2 to 3 weeks if you want to get a refresher on that.
Yeah, thank you very much. Yeah, anybody looking for our webinars, they can just go to www.rcthornton.com. There is a button on our homepage that says webinars, and you click on that. It will take you to a list of some great tax saving strategy webinars and some other things in there you might be interested in. Thank you so much, Chuck, for this great presentation today. Appreciate your time. And I also want to say thank you to AIA for sponsoring this, and for the chair of the AIA Small Firm Exchange, Jack Leonard, for being on our presentation. Thank you very much, everyone. If you have any questions, please give us a call or send us an email, and have a great day.